cups down and join me in a round of applause for Yark. Good work, buddy. Had some very good things happen over the last couple of years for the organization. As you know, one of the big real estate magazines has given the stamp of approval, and that's a big coup, big thumbs up. Yark has a few words to say. By the way, my name, as you can probably already tell, is Richard Burylo. I'm here today helping Yark out, and I'll be your host and moderator for the day. Yark has a few things to say, so let's just go ahead and a round of applause again for Yark. Come on.
Hi guys, how have you been doing today?
Very good.
Don't hear it now. Come on. Listen, I am so excited because one of the passions which I have in my life is how to help real estate investors and how to be successful for myself. I am a very selfish guy. I'm very honest with you. But how do you think that if you will help all of us together, I will be more successful than you, right? Is that right? Come on, guys. You don't have a pulse or what? Sorry about that. You are recording anyway. All that presentation is on live. Live is really live on the internet, and we start broadcasting this livestream.com. And some of the CanadaREIC members, which they cannot participate because they are unfortunate, they live in somewhere else than Calgary. Rocks, right? They listen to us and they are watching that presentation online, right? So it's high HD defined, and just to let you know. So there will be some interactions from other people from all over the Canada, maybe in the world, I don't know. We had some guy from Hong Kong participating very often for our events, right? Anyway, I don't want to waste your time. You know my name, Jarek Buchholz. Here we go, right? And you can talk with me, you can interact with me, and I will be available, and I will be happy to talk with all of you, and the way how our organization, Canada Real Estate Investors Club, can help you, right? The primary goal is, this organization is run by investors for investors, and this is your club, it's not my club. I'm just a guy who try to accommodate you and help you to be successful, okay? Mr. Rick?
Thank you.
Thank you.
Thank you, Yark. Quick show of hands in the room here. Who actually filed and paid taxes this year? Come on, be honest. Okay. Well, in 2010, I had bad news for me. My business partner comes up and he says, sign here, 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 and here. Give me a check for $2,700. We're going to get this thing done. Because I hadn't submitted since 2005. Bad. I know. I'm probably like some of the people you know in business that also have had a problem with that kind of thing. Luckily for me, a young man was visiting with his friend Agostino, with the president of our company at the time. And this young man jumped up and ran out of the room and said, did I hear somebody talking about taxes? And I said, yes. And he shook my hand and he said, hi, I'm Chris Burylo. And I said, great to meet you. I see you're in there with Agostino and Megan. You do taxes? He goes, I love taxes. He said, I read taxes, I sleep taxes, I eat taxes, Okay, we'll leave it at that. So he took my box of receipts, my garbage bag full of all this stuff, and he came back a couple weeks later and said, sign here, here, and here, and the government's going to send you a check for $8,900. Click. Over the last couple of years, I've sent Agostino a whole bunch of referrals because this kid is an amazing man of taxation and structure and strategy. And what you're about to see today will get some of the mental firing pistons going for you. Make sure you connect with him. Give him your business card. Ask him questions. Wait till you see what he's got here. This is very cool. Ladies and gentlemen, can I please introduce my good friend, tax guy, Chris Burylo.
How many of you feel like you're doing this? Like every day, you get up in the morning and everything's a juggling act. Seriously, put up your hands. How many of you feel like you're doing this? I know whether it be in life, you're getting up, taking the kids to school. I know my fiance is always complaining about having to put on the laundry, or it could be in work, or just dealing with emails, the kids. Things come up. I'm sure we can all remember a time when we were younger, when things were quite a bit more simpler, when we only had one or two items to deal with. I know for myself, when I was younger, my mother filed my taxes for me. It wasn't something I had to deal with. But as life goes on, things evidently become more complicated. And what happens when things become more complicated? You throw another ball into the mix, right? And sure enough, you drop one. And that's what happens. Now, wouldn't it make more sense if we could find a way to better juggle what's happening in our life, better juggle our general life, better juggle our business life, better handle our administration, and more importantly, save a bit more money on taxes. Okay? When I was young, my father, Rod, he's going to be speaking later today, you'll get to hear him, but my father built me a soapbox. And this is a thing when we were young. We put on these little soapboxes, and you race down a hill against some other children whose fathers also built soapboxes. But what's important here is that my dad, at the time, he was working and managing an investors group office. You can see I had a little investors group license plate. I had an investors group hat. And my dad was not a handyman. He did not build things for a living. He had lots of things he was great at, dealing with people and solving your money problems and with investments, a lot of great talents, but building a soapbox was not on his priority list. Like many of us, he had to go to the neighbor, he had to borrow the tools, he had to borrow a hammer and a wrench or a handsaw or whatever he needed to put this soapbox together. Well, we show up on race day, and to my astonishment, I was quite proud of my soapbox, but to my astonishment, a lot of the other kids' dads built far more elaborate soapboxes. I remember being lined up on the race line, ready to go, and I looked to my right, and the kid's father had built him this like shark. The thing looked like it was made of, I don't know, I want to say paper mache, but it doesn't make sense. It was phenomenal. And to my left, the kid's father had built like a boat. The thing had a mast with a sail that it used to help carry it down the hillside. Anyways, it's go time, and we start going down the hill, and to my astonishment, one of my wheels actually came off the socket and kind of rolled away behind me. I had to kind of readjust on my soapbox so that my soapbox didn't scrape on the ground. So we ended up getting a prize that day, but it wasn't for being the first one down the line or having the best looking go-kart, the soapbox. It was for being the only contestant to finish the race on 3 wheels. We got a little Royal Bank mouse pad to celebrate. But the purpose of the story here is that while my dad and I were able to get the job done, we were able to create a soapbox, but because we didn't have as much knowledge or the proper tools to build the soapbox like some of the other children's fathers did, we weren't able to get the same results. We weren't able to relate this back to taxes. We were able to file the taxes, but we weren't able to file the taxes in the most opportune way. We weren't able to reduce the taxes as much as possible. How many of you have ever seen the Income Tax Act? Seriously, put up your hands. There's just a few people in the room. It's an ugly piece of mess. I brought my version with me today from 2008, the Practitioner's Income Tax Guide. Anybody have a guess? How many pages do you think are in this?
2,000. Too many.
Too many, yeah. My particular version here has 2,378. And I mean, the writing on these pages is so tiny, and the paper, you can literally see through it. Okay, this thing is complicated, and I mean, there's a lot of working pieces to the Income Tax Act, and the better you can know it, the better we're able to apply it to our situations and better save a little bit of money. I'm gonna guess nobody knows who this woman is. She happens to be an idol of mine. This woman's name is Linda Lizotte McPherson. Okay? Now, a lot of you on your notice of assessments, you might note near the bottom of your notice of assessment, it says Linda Lizotte McPherson, and this woman is actually the president of the Canada Revenue Agency. So most of us have never seen her face before, but we've all seen her name on our notice of assessments. And her job down at the Canada Revenue Agency is to make sure that everybody down there is making sure that these rules are being followed when people are filing their taxes. Okay? So at the end of the day, what we're getting here to is a quote that Einstein put the best. He said that the hardest thing in the world to understand is income taxes. And I know when I first showed this to somebody, she didn't think that this was an actual quote. Einstein actually said this, but it should also be noted that Einstein also said that in the middle of every difficulty lies opportunity, just like our income taxes. Which is why, for our benefit, I've created some of the top tax questions that we get at our firm. And what we're going to do today is we're going to go over a bunch of these questions. I'm not going to answer all of them because I'd probably be boring some of you to death. But we're going to answer a lot of them, and I'm going to pay particular focus on tax planning around real estate because that's what we're all here for. Does that sound like a good idea? Yes. Great. So, first question here. What is the working income tax benefit, and why can't I claim it with my own tax software? This is such a peculiar question. I mean, most of us probably have no idea what the working income tax benefit is, first of all, but it's basically a credit that you get. It's free money that you get if you're working here in Canada and you're in a lower income tax bracket. And for some reason, I was dealing with a client not too long ago this particular client had filed their taxes but was missing the working income tax benefit, and it became an opportunity to go back and adjust that benefit to make sure that they were getting a refund. You know, it's an opportunity for somebody who's making $8,000 or $10,000 to get a little bit of tax savings. Thank you, York. You're welcome. Yeah. So I guess question number one: what is the working income tax benefit? If you're filing your taxes on your own and you're in that low tax bracket, make sure that you're getting that working income tax benefit because it's an easy $500 or $1,000 for you. Question two: what do I need to claim the children's fitness amount? How do I capture my child care expenses? Of course, if you have a nanny or a home carer who's taking care of the kids, you can claim those expenses on your taxes. How do I capture my moving expenses? Here's a good one. I'm an employee, but I want to deduct my expenses like a business owner. How do I do that? This is such a neat opportunity, and if you're somebody who's working for a smaller company, say, and you're responsible for maybe some of your own transportation or providing some of your own supplies, there's actually a form that the government issues. It's called a T-2200, and so long as you're able to get your boss to sign the form, you're able to take all of these expenses and deduct them on your tax return, just like you would if you were a business owner. So it's a real neat opportunity for employees to take advantages of some of those really neat tax planning opportunities that you get as a business owner. How much of my spousal and child support payments can I deduct? How do my pension plan contributions affect my taxes? What do I need to claim my public transit costs? Such an easy one. If you're using the train, keep your ticket. How do I claim my medical and dental expenses? How do I claim my professional dues? A lot of people, nurses, engineers, lawyers, you're going to be paying annual dues. You, of course, can be capturing those on your taxes and deducting them. Someone else paid for my education. Can I still claim my tuition and textbook credits? The answer is absolutely. If your employer is paying for your education, or your parents are paying for your education, thanks, Dad. You can be sure to be, you can still claim those on your taxes. I don't consider myself disabled. What do you mean we can still claim the disability tax credit? A lot of you might not realize the Income Tax Act actually has their own definition of disabled, much different from what we would perceive as being disabled. And it means that there's an opportunity to be getting a whole bunch of extra tax credits. So somebody who maybe has a grandparent who's getting a little bit older, losing their hearing or something, those are opportunities for us to be looking at that situation, looking at that person and saying like, okay, can we get 8,000 tax credits here? It's worth quite a bit of money if you can do it. How do I claim the interest on money borrowed to invest? I've set up a mortgage reduction plan which has preferential tax treatment. How do I claim it? Can I claim my accounting fees? If you have a complicated investment situation, you're holding rental properties, definitely we should be claiming those accounting fees and expensing them on your tax return. How do I eliminate the taxes on my rental property? I don't know how many of you have met my fiance Michelle. She's at the back of the room here today. And she's actually got a couple handouts on all of the expenses that we can be capturing on our rental properties. I'll go over a couple of them with you just as a quick reminder. Things like utilities, property taxes, home maintenance. If you're doing any kind of add-ons to the property, absolutely we got to be capturing those. Some of the more unique ones that are often missed, interest on the mortgage. Two, if you are managing your own properties, you sometimes have to drive to the properties to do repairs or pick up checks. In those situations, we can be capturing part of your automobile expenses. Or my personal favorite, the capital cost allowance. Did you know when you own a rental property that you can actually take the value of the physical structure and decrease the value slightly on your tax returns to offset any revenues? It's a really neat opportunity, a little bit complicated. I actually had a situation this year. Feisty old woman, she shows up at my office, she's like 85 years old, just energy like you wouldn't believe, and she had several properties, and I was going through her past year's tax returns, and she was paying taxes every year on the revenues from her properties. I was surprised that the accountant was a CGA. Most people say, oh, CGA, he must know what he's doing, but it's such a common thing that even accountants miss it, where we were able to go back and adjust all of her tax returns for the last 5 years to depreciate those properties and save her on her taxes. This particular woman got a tax refund of $12,500. She said to me like, Chris, I just about fell out of my chair. So it's such a great opportunity. You want to be making sure that you're capturing that for sure if you're having rental holdings. My investments returns are in the form of return of capital. Can I still claim interest on money borrowed? My investments provide me with a T5013 slip. Those are the big tax slips for limited partnerships. They're a full page. And my tax software won't let me claim it. What should I do? I see this so often where tax software just doesn't, when you're trying to do your taxes on your own, it just doesn't have as robust features to be able to capture some of those more complicated situations. You either need a much more expensive program or an accountant who knows what he's doing. What can I deduct against my business revenues? Again, we could have an hour conversation on this. If you're interested in that, Michelle has a handout. Make sure you see her later and get a copy of it. My business is already in a loss. Is there a benefit to further deducting expenses? And the answer is absolutely there is. If it's a corporation or a sole proprietorship, the further you can put that business in a loss, that's your opportunity to be taking those losses and either carrying them forward or carrying them backwards to use to offset other revenues. Or in a situation where maybe you have a business, but you also have a job, you can be using those losses on your business to be offsetting the revenues from your regular job to trigger a tax refund. So very neat opportunity. So even if you might say like, yeah, Chris, I've got a small business, I didn't make that much money this year. What's the point in spending all this time going through these expenses? It's critical. On your personal taxes, it might be worth, call it 32%. 32 cents for every dollar you expense is 32 cents in tax savings. So it's a great opportunity to be making sure that you're saving taxes, whether it be for this year or a year in the future. Should I lease or purchase my new car? What percent of my home should I claim? I was dealing with a really unique case last year where the client of mine had they had a house attached to almost like a manufacturing facility, okay? And the actual floor space was about 50-50. It was about half house and half the manufacturing space. For those of you who don't know, there's typically two ways to calculate the use of home expense. One is by the square footage. We could say half of the square foot is for manufacturing, half of the square foot is for the house, so we expense half. The other mentality is to say how many rooms are there and how many rooms are we using for the business. In the case of the manufacturing, they had one room for the manufacturing and call it a dozen rooms in the house, which would mean you could expense 1/13 of the use. But in this particular case, the manufacturing plant had it went floor to ceiling, was about 4 stories. It was just this giant open space where, I don't know what they did, they had chemicals and stuff, but it became a neat opportunity for tax planning that was often missed because we're actually able to expense a greater portion because we expense based on cubic feet, where, you know, it was the half of the square footage plus 4 stories upward allowed us to expense like 75% against the use of the property. So kind of an obscure situation, but a really good example where if you know that one line in the Tax Act and you know how to apply it, all of a sudden you got a client who's just, you know, saved a ton of money in taxes. Really neat. Do I have to keep a kilometer log? How do I expense medical and dental against my business? How many people here have a private health spending plan? Yeah, 3 or 4 of them. If you have a business and you have any kind of medical or dental expenses, even if you have, like you pay monthly dues to Blue Cross or something, these become opportunities to be taking those expenses and expensing them to your business. It also becomes a really neat strategy in the future if you're ever traveling and you have an emergency situation where you have to pull some money out of the company to cover emergency medical costs. It can become an opportunity to be using that money, expensing it to the business, and giving you better access to money that might be in a corporation. If you don't already have one, private health spending plan account, by the way, see Michelle. She's got a bunch of the paperwork to make sure that you guys get one set up. At what point should I incorporate? What a great question. I know a lot of people are, well, you know, it's expensive to incorporate. There's more administration. I typically find, depending on your accountant and how much they're going to charge, I know when we're dealing with clients, kind of the magic number I like to use is about $30,000 to $40,000. If you're doing that $30,000 to $40,000 in a business, incorporating can become an opportunity to take advantage of some other really unique tax planning opportunities that's available only to business owners and applying it to your revenues. So it becomes an opportunity to save more taxes than it would cost to have one set up. What are the benefits of incorporating? Should we declare dividends? What the heck is the shareholders loan account? And how do we use it to reduce and defer taxes? When I'm doing tax planning for a lot of our clients, I like to make reference to the 3 Ds of tax planning: deduct, divide, and defer. Okay? How much are we expensing against our business? Dividing, how many members of our family can we split this up amongst? This is typically called income splitting. It makes more sense for have multiple people having a little bit of revenue in a lower tax bracket than 1 or 2 people having most of the revenue in a higher tax bracket. And deferring, how much of these taxes can we save for the future? So, you know, one of the plans when you're sitting down and looking at your corporate tax planning becomes like, how are we withdrawing that money from our company to best take advantage of these different opportunities? So when we start talking about things like dividends, shareholders loans, or my personal favorite, bonus accounts, each of these are opportunities to be taking advantage of the 3 Ds of tax planning. I mean, about half of the Income Tax Act has different strategies that we can be using to be deducting, dividing, and deferring our taxes. So really neat opportunities. How should I structure my shares? What is a holding company and how does it help me? When should we add a family trust to our structure? We're going to raise money for our business. How do we need to structure things to be tax efficient or securities compliant? What investments are tax efficient in my corporation? What investments are tax efficient in my corporation? I know a lot of us, especially when we start getting into the real estate game, we start asking questions like, well, how should we structure these things? I know a lot of us are probably familiar that by putting things in a corporation, we're able to limit our liability. Of course, if the boiler blows up in your rental property and injures a child, you don't want to be personally responsible for that. Keeping it in the corporation can provide some protection in that area. But what's more important here is all investments in a corporation aren't necessarily tax efficient. Right? I know probably the best example of this, or maybe the best way to explain this, is when we start dealing with business revenues and business expenses. In tax planning, we make reference to the term active business income versus passive business income. And a lot of you who are in the real estate game, you're like, yeah, passive, income. That sounds awesome. That's what we're all here for. But for tax planning, what you really want is active business income, because the Tax Act, again, has different definitions for all of this stuff. A lot of us are probably familiar that in our corporate account, business income here in Alberta is taxed at only 14%, so long as it's under $500,000. But that only applies to active business income. Doesn't apply to that passive income. Passive income here in Alberta is actually taxed at like 44.5%. It's much higher than your personal income. So when you start dealing with tax planning, I know I meet with a lot of people who are out there working and pulling all this money into their corporate accounts and then trying to invest it from that corporate account. Like a lot of people would argue, like, yeah, it makes sense. I got money here. Let's go buy a property and fix it up and sell it, or let's go buy a property and rent it out, or whatever that structure looks like. But at the end of the day, it might not necessarily be tax efficient. Okay, so a corporation is for tax planning is best used for running a business. But as soon as we start getting into investment holdings, it's not a very tax efficient place to be holding our money. In 1986, there was a Supreme Court case. It was between Insight Limited and the Queen. Okay, and this is kind of in tax planning has become the case that we reference when we talk about passive business income versus active business income, passive versus active. And in this particular case, Insight Limited, they had posted some government bonds, and they were using them as collateral for lending or borrowing money. And in this particular case, those bonds that they had, they were claiming the interest on the bonds as active business income. And this went all the way to the Supreme Court of Canada, because Canada was arguing, like, no, that's bond interest. That's definitely passive income. But at the end of the day, Insight won the case. And the reason that they won the case was because having those bonds was a critical part of their business, because they were using it to leverage the money that they needed, to borrow the funds that they needed to operate it. So one of the tests that we use is if we didn't own this asset, would we be able to run our business? And generally, the Tax Act says that yes, if you own a rental property, that is passive income. However, if we make a business model around that, for example, if you're buying property, fixing it up, and reselling it, you are in the business of buying property, fixing it up, and reselling it. It's not enough, though, to say I'm in the business of buying rental properties and renting them out. The Tax Act will basically argue, like, no, that's still passive income. The other test that we look at is, do we have more than 5 full-time employees? If you have a significant operation and you have a staff base, you can, by the number of full-time employees that you have, will define whether or not you're dealing with active or passive business income. Okay? So when we start talking about, man, I'm in the real estate game, I'm investing, what are we doing, and what does this structure look like? It becomes very important to look at those kind of details, because if we can call it active business income, it makes so much sense in a corporation because of the tax planning that goes along with it. Like we're talking about the shareholders' loans, the dividend accounts, the bonuses, all that planning that goes in there, plus the lower tax rate, it makes a lot of sense. But if we start coining it passive business income or investment money, it doesn't make a lot of sense in the corporate account. And at that point, maybe you have to look at some other options. Things like holding the assets in a family trust, holding the assets in a partnership or a limited partnership if you're dealing with investment money, or just owning the property personally. I mean, a lot of times if you are in that situation where you're bringing in that corporate money and you have extra money sitting in your corporate account, it can make some sense to just try to, in a most tax efficient way possible, get that money out of that corporate structure so that we can be investing it somewhere that makes more sense for tax planning purposes. Is that neat, or am I a tax nerd? Okay. I told Michelle on my Christmas list this year, she's going to get me a big button that says, I heart taxes. I'm really looking forward to it, so I can stand here and be like, yeah, hearting taxes, that's great. Another really neat opportunity for tax planning in a corporation with regards to your real estate holdings. A lot of us are probably familiar that when we sell a piece of property, we get a capital gain if we're making money. When we sell a piece of property in our corporation, that half of the capital gain that you normally take tax-free, but you still take it tax-free in the corporation, but you get something else along with it. You get what's called a capital dividend account. And this is different from a regular dividend. This is a capital dividend. And what happens with a capital dividend is that's money that we can withdraw from our corporation on a tax-free basis. So again, when you start playing in that real estate game and figuring out what structure is going to work best, it's another tool to kind of keep under your belt to put things together. I was dealing with a client just this year, actually, sold an apartment building and had a capital gain of $200,000. And this particular gentleman had some other revenues that he was dealing with. He had his regular day job in addition to owning this apartment building. And when he got that $200,000 capital gain, he got along with it a $100,000 capital dividend account. And what this became for him was an opportunity to withdraw $100,000 of his regular income that he was withdrawing anyways, but withdraw it without paying any taxes at all. So now with that gentleman's tax planning, it becomes like, okay, so we've got dividends here. We're going to play around with this shareholders loan account and how that fits into our tax planning or how we're declaring our bonuses. And in addition to that, we have this capital dividend account that we can kind of insert into the mix. It becomes a really neat structure. I got one more key piece of advice with real estate tax planning, okay? Because I know you guys are all excited about it. A lot of us are familiar with the primary resident exemptions. If you're the house that you own, the house that you live in, when you sell it, any of the gains, you don't pay taxes on them. What you might not be familiar with is that you don't have to apply it to the house that you're living in. If you're in a situation where you own your own home and you own a couple other properties, you can elect to have any one of them be the primary resident. And what that would mean would be that you would pay taxes on your own house when you sell it, but one of the other properties, you would elect to have that as your primary residence and not pay any taxes on the capital gain at the time of the sale. So there becomes some neat tax planning around that, where you can say, like, okay, well, I'm going to hold on to my main house forever, so I'm already deferring taxes. But if I'm buying and flipping properties, I can be electing one of those to be my primary residence every year, to be saving taxes now and paying taxes in the future on my own property. Or another option would be, if you're renting out a property that is much bigger and nicer than your own, maybe it's going to have a bigger capital gain at the time of the sale. So you can say, well, I'm going to pay taxes on my primary residence, or the place where I actually live, but I'm going to declare this bigger property my primary residence and take that on a tax-free basis instead. So some really neat tax planning that goes along there. So, you might be wondering, I got a question.
Don't you have to leave a certain amount of time in that house that you can claim as your residence?
That's folklore. It's actually based on a formula. And it's, I can't recite the formula. It's like the property you claim from this year to that year plus 1 divided by the total number of years or something like that. It's a complicated formula. So you don't actually have to live there at all. But you do have to file paperwork for it. There's special tax forms that have to be filled out, and you need to kind of map it out. You can't just like, oh, I'm going to claim this as my primary residence this year and just decide that in your head. It's like you gotta fill out the proper paperwork, and you gotta have a proper plan for that.
I thought you need to stay at least for 2 years out of 5 years to make that claim.
I think what you guys are confusing with is I believe that is with regards to mortgages or CMHC approval.
No,
Where
it's tax, it's regarding tax.
I 100% that you're mistaken. It's a form.
Yeah, I know that you have to live at least 1 year in that property in order to offset the capital gain. So that's what I.
If you want a year, you have to live in 4 months.
If you guys want to see me later, I'll help you with the forms and stuff like that. Anyways, yes.
Would it affect federal tax, for example, if you picked a property that was outside of Alberta, for example? Does it have any impact on that?
That's a very interesting question, and I believe that it has to be a Canadian property, but I have to double check the rule. So you guys are probably wondering who we are. That's myself and my business partner, Agostino. I'm the head of Pinnacle Accounting. He's the head of our finance department. Our organization is called Pinnacle Equities, but I manage the subdivision Pinnacle Accounting. So we're an 8-man team, and our accounting department deals with everything from full cycle bookkeeping, corporate tax planning. We're setting up your limited partnerships, setting up your family trusts, and running all that tax planning. York didn't mention, but I'm the official tax man of the Canada Real Estate Investment Club. So we've been dealing a lot with different types of real estate investors and the planning that goes along with that. Thank you guys very much for your time. Anybody have any questions?
I have one.
Yeah.
What do you think of tax shelters?
What kind of tax shelters?
Like for example, there's one called GLGI, and it's where you put in $2,000 of your own cash, and then they put a donation of $6,000 every yearly.
Right.
You technically have a tax savings of $4,000.
Right.
So something like that.
Yeah, I have a very strong opinion on that, and it's probably a 5-minute discussion. So maybe I can tackle that one after the presentation today. Great. Anybody else have some questions?
The scenario of the gentleman who had a property where he had a $200,000
Capital gain?
capital gain
Yeah.
and used the dividend.
Right.
Now, had he not structured that way, how would have, like, if he did not know about this dividend program,
Yeah.
what would have been the results otherwise?
Well, the capital dividend account is something that you have to apply for at in the year of the sale. And had he not applied for it, he wouldn't have had that capital dividend account, which means that those withdrawals he would have made from his corporation, he would have had to pay full taxes on or find another way to tax plan around them. So, yeah, good question. And that's a common one missed by a lot of tax accountants as well.
And who qualifies for that? Like, do you need to have a certain amount of revenue to qualify for the?
No, it's based on, there's certain types of income streams that qualify for the capital dividend account. The most common one is the half of the capital gain that you take tax-free, but some of the other common ones are, a good one would be like life insurance proceeds. Or if you pass away, you take your life insurance tax-free. If you take it into your corporation, you can use it to get a big capital dividend account. So there's kind of like very few situations where it applies.
Thank you.
You're welcome.
How old the kids have to be as your employee in your corporation?
There are no age restrictions. I mean, for employment standards, I'm sure the government has something like you can't hire somebody under 14 or something like that. I don't know what the rule is. But for tax planning, there are no restrictions. I've got a client of ours where there's husband and wife, and they actually have 8 children. And they homeschool all of them, and the family runs a couple businesses out of the house. And it's really neat because they put the children to work. The girls, they fold sheets for the hotels, and the boys build fences for the neighbors. And they put the whole family to work, regardless of their age. But it comes for a really neat tax planning situation because all of a sudden you got a 14-year-old, a 15-year-old, a 16-year-old, and a 17-year-old who are all taking personal income on their taxes. And I mean, personal income, you can take, about $10,000 tax-free. If it's a dividend from a corporation, you can take about $30,000 without any personal tax ramifications. So if you're sitting in that corporate structure and you got, 8 children that are, you can legitimize, into your tax plan, it becomes a neat opportunity for tax planning. You're welcome. Great. Thanks again. Oh, sir, is that one more question? No? Perfect.